Hi there and welcome to Icebreaker channel. Today we are diving into a question a lot of people have. What does the Fed actually do? Alright, let's jump in. The Federal Reserve, or the Fed, is basically the US's main bank, setting the country's money rules. Their job is to keep track of how much money is moving around the economy, essentially the cash flow that we use to buy things. By managing this, the Fed can control interest rates and keep the economy in check. The Fed mainly focuses on two things: keeping unemployment low and inflation steady. To do that, they've got a few tricks up their sleeve, but the main one is controlling the federal funds rate. This is the rate banks charge each other for short-term loans. Sounds simple, right? But here's why it matters. Banks are required to keep a certain amount of money in reserve to make sure that they can cover customer withdrawals. If they're short on cash, at the end of the day, they borrow from other banks, and that's where the Fed steps in to control the rate on these loans. When the Fed raises this rate, borrowing becomes more expensive for banks. In turn, banks bump up the interest rates they charge their customers, basically everyone else who needs a loan. This is how the Fed's changes impact other rates through the economy. So what happens when the Fed wants to give the economy a boost? If things look slow, they lower the short-term rates to make borrowing cheaper. When that happens, banks can offer lower rates to customers, which encourages more borrowing, spending, and investing. Ideally, this leads to economic growth. But changing a rate isn't as simple as flipping a switch. The Fed uses what's called open market operations, buying and selling government's bonds, to steer the federal funds rate toward their goals. Recently, they've also been using quantitative easing, or QE, where they buy longer-term securities to push long-term rates down. This move can help boost important economic indicators like unemployment and inflation. Lower rates make it cheaper for people to get mortgages or for companies to borrow for more new projects, which usually means more jobs and economic growth. But if the economy heats up too fast, we get inflation, which is just a fancy way of saying prices go up. To cool things down, the Fed raises rates to make borrowing more expensive, slowing down spending, and ideally keeping prices steady. Now that you've got a sense of how the Fed handles interest rates and why they use open market operations, you'll be better prepared next time you hear about the Fed's latest moves. Let me know if you like any more tweaks. Thanks for sticking around till the end. If you enjoyed the video, we'd love it if you hit the like button and subscribe to the channel. And don't forget to tap that notification bell so you'll know right away when we drop something new. Stay positive and keep pushing for those gains. Here's to more success and more money.